And now it's time to bring in Dr. Mark Skousen. He's investment expert, economist, university professor, and the author of more than 25 books. He's also the editor of Forecasts and Strategies. Mark, thanks so much for joining us today.
My pleasure, Dave.
So, what do you think? You know, these forecasts so far we've been talking about on the show, whether it's Dow at 40,000 in 2 years or even Dow at 40,000 in 6 years. Possible? Probable? Not probable? What do you think?
Anything's possible. I mean, we're in the mother of all bull markets that have lasted over 10 years. So a lot of people are thinking this is the longest bull market in history. We need a breather. We need a correction. Certainly a recession. If we had a recession in the next year, you'd see the Dow come down. But, you know, there's nothing that I see in the horizon that would cause a major recession. Certainly, if we adopt protectionism as a permanent policy instead of a trade negotiation, that could really hurt the United States in the long run. Globalization has been really good for America overall, but we don't really know if it's just Trump is involved with the trade negotiation, or there's a lot of indications that he actually believes in protectionism and America first and so forth. And if he does, that's a dangerous strategy.
But if he doesn't, and let's say we get sometime later in 2019, we get the trade deal worked out, then, you know, the Dow at 40,000 in 6 years, as some say, isn't really that crazy. That's an average growth of 6.75%. Throw on some dividends, it's probably an average return of 9%. So in essence then, what you're saying is if you're right, and if we could avoid any recession or certainly major recession, it's not crazy to think a Dow at 40,000 in 6 years.
There's three factors to look at. Fed policy, if they get too tight, that could hurt the economy. Adopting socialism, which I would include protectionism in that category, and overregulation. And then finally, just a major geopolitical event, whether a war or terrorist attack, could all knock the Dow down for a while. But American exceptionalism is still very much in play. The U.S. markets have led the rest of the world. I see that trend continuing if we encourage entrepreneurship and supply side policies, the tax cuts and deregulation that Trump seems to be supporting.
So, in the 1 minute we have left in this segment, let's talk about Fed policy. Has the Fed contributed to any signs of recession that economists are seeing? I know you don't see a ton, but there are some. Has the Fed contributed to that? And conversely, what should the Fed do to fix it?
Well, when the Fed engages in too easy money policies, and, you know, the low interest rates and easy money quantitative easing that we've seen recently, that causes a artificial boom that will result in a bust at some point. But I'm relatively optimistic, have been. I'm 100% invested at the present time. So if the Fed keeps raising rates, doesn't look like they will, then I think we could continue to see a growth pattern both in the Dow and in the economy. So I don't see a recession at this present time.
Interesting. You know, you are looking for the opposite of what all the so-called drug addicts are looking for on Wall Street. And I want to talk to you about that just a minute right after the break. So stay with us. And you stay with us too. We'll be back here with more on the income generation. We'll be back in a moment. Now it's time to bring back our friend, economist and investment expert, Dr. Mark Skousen, author of Forecasts and Strategies. So Mark, you know, it's funny because I mentioned this right at the end. So many of the Wall Street drug addicts, if you will, the ones that are addicted to this drug of quantitative easing, seem to want the Federal Reserve to go back and ease again. You're saying that easing could actually create a recession. You really want to see them stay level with interest rates, or maybe eventually raise rates slightly and cautiously. Am I hearing you correctly?
Well, we're certainly at a situation where interest rates are still at extremely low levels on a historic basis. And there's some evidence that that will continue because remember, the baby boomers are now retiring. The supply of capital is increasing because people fear they'll run out of money. So interest rates could continue to decline. This is very bullish for the stock market and the economy if that trend continues. So I see no reason. I think it's just happening in and of itself. There's no reason for the Fed to push it along by expanding the money supply and trying to get inflation going again. A lot of people are saying, well, they need to inflate more. I don't think so. I think they should maintain a stable course and let interest rates fall if that's what the bond market is telling them. And I think that's what is happening. So I think there's reason to be optimistic about what is happening as long as the Fed doesn't tighten too much and create what we call the inverted yield curve, where short-term rates are higher than long-term rates, and it is at that level right now.
That's right. That's right.
That is a danger sign. I don't think it's too serious this time because interest rates are falling across the board. It's just which rate is falling faster, short-term or long-term rates.
Now, it's interesting. You know, Mark Faber was a guest on our show last week, and he said that in reality, we are seeing inflation, that the Fed is looking at the old textbook definition of inflation, but asset inflation should be counted. And if you look at asset inflation, we are seeing inflation. We are seeing a result from all the quantitative easing and the increase of the money supply. Have you ever thought about it quite in that way?
Well, yes, and as a practical person, we see this all the time. There's some disconnect between the consumer price index, the CPI, and what's happening in the real world. When you send your kids to college, you pay for an accountant, you go out to dinner. There's all kinds of, you can't just look at fast food and what's happening in the grocery store. You need to look beyond that. And so, but this idea that the Federal Reserve should stimulate inflation, I don't think that's a good idea at all, because that can create an artificial bubble as well. And we have seen it in real estate prices are increasing rather dramatically. So I'd like to see, gold is a good indicator. Gold is relatively stable, but it is moving back up. And that's a sign that inflation is picking up. So that's a danger sign.
Yeah. And like you said, you're trying to avoid any major pullbacks in the market, which if the Fed should lower interest rate eventually, short term, it might be okay for the markets. Long term, it's just a bigger bubble. But I need a few minutes because I have to ask you about this Freedom Fest that you're sponsoring. Tell our Income Generation members about this, please.
Yeah, Freedom Fest is an intellectual feast in the entertainment capital of the world. So we meet in Las Vegas every year. This year it's July 17th through the 20th. We have over 2,000 people coming. Newsmax has been there a number of times. And we have Kevin O'Leary of Shark Tank fame coming, debating John Mackey. We've got Penn Jillette of Penn and Teller. We have Steve Forbes and Steve Moore coming, people who can talk about government policy and what's happening in the world. So if people go to freedomfest.com, they can find all about it.
I want to go there just to be able to play blackjack right beside some of these intellectuals. It might increase my odds a little bit. Thanks so much for being on the show. We really appreciate you being here, Mark. Thank you.
Yeah, my pleasure, Dave.
And you stay with us too. We'll be right back here on the Income Generation.